Joining me live from Singapore with more on Asian economies in 2012 ex-Japan is Sanjay Mathur, the Head of Research and Strategy for, again, non-Japan Asia at RBS. Many thanks for joining us and happy holidays to you, Sanjay. Looking at your research again, clearly a lot of concerns. First of all, you start by saying we go into next year, and just to use your words, considerable uncertainty, and we assume that. We do, don't we? We always assume that central banks and various people will bail us out, but actually it's wrong to assume, isn't it?
Yes, it is. I think, as far as growth is concerned, it was, Q4 2011 story. We've already downgraded growth forecast. But what's interesting is that, across the board, when you look at the forecast, it's all a slowdown in exports. What is happening to Asian growth is that we are shifting more and more towards domestic demand. And that basically suggests that, the growth inflation mix in Asia is changing because domestic demand or domestic industry is not an area which already had built a lot of excess capacity. So all of a sudden you have growth shifting towards the domestic side with less capacity, and that basically means that despite slower growth, you might not get inflation coming down in a significant manner. So what you're likely to see is on the monetary side, small cuts of 50 basis points maximum, and that's not what the curves are pricing in today. So I think there's scope for disappointment on that front.
What are they pricing in? I mean, how bad is it, do you think, for example, for China? We had today Mark Mobius talking about 7% growth next year.
No, on China, well, we are fairly constructive at this stage. We are looking at growth a little over 8%, and our rationale is that on the monetary side, there will be no rate cuts, but they will definitely cut the reserve requirement ratio. Second, there are still quite a few public sector projects that are due for implementation. Thirdly, we've seen a fairly active wage policy out of China that has shored up domestic incomes. And to that extent, despite a slowdown in exports, growth would hold up all right.
Exports is definitely one of the concerns. You do say, in fact, the credit risk has yet to surface in two countries, India and Indonesia. How bad do you think the problem is, for example, in India?
I think in India the problem is more acute than in Indonesia. What we are seeing in India is that we've just ended a fairly aggressive credit cycle, but now credit cycles in India have been, have gone on for long periods of time, but we are now entering a period where growth is slowing significantly. And you look at across, the Indian economy, you look at infrastructure projects, they're not happening, consumption is starting to slow, and the fiscal position continues to deteriorate. Now, all of this, to me, would add up to saying that next year we could see a significant rise in NPLs. Now, that will not crush the banking system, but it does increase the level of risk aversion vis-à-vis lending.
Actually, one of your top trades involves Indonesia, doesn't it?
Yes, it does. We are looking to buy protection in Indonesia. I think all the good news, in terms of ratings, etc., is now there. What we haven't seen, and one of the issues with Indonesia, is that they've had a dramatic run-up in foreign ownership of assets. And given the choppiness in the markets, the European situation, and then you have a domestic monetary policy that seems unusually easy for this point in time, we do think that the risk on the credit is significant, and we are looking to buy protection on Indonesia at this stage via the CDS route.
Also, the other two is about China and Korea. I'm going to start with China, if I can, and go to Korea at the end. China, it's all about the currency appreciation, isn't it? What's your trade there?
No. Well, what we are actually saying is that in the first half, the currency has much more two-way risk. What we've seen is that China's current account surplus has been steadily coming down. And in terms of real effective appreciation, that's also been pretty solid. So as you hit an air pocket as far as growth is concerned, a slowdown, albeit it's not 7%, as I pointed out earlier, you could see more two-way movements, and we think that that pressure would be first felt in the CNH market. So we are somewhat more careful and cautious on trying to predict that the renminbi is still on a one-way appreciation path, at least in the first half of the year.
I've got to end now, really, with what has been historically huge for Korea this week again, the death of Kim Jong-il. And again, we're talking about, in fact, demand-supply bond dynamics favouring the Korean won. Can you explain the trade behind that? And also your reaction to the whole transition uncertainty.
Yes, I think that, well, first of all, when you made the trade, when you put out the trade, we had no idea this is, about the North Korean situation. But that said, I think it's important to sort of look at the way Korea has been moving in terms of fiscal policy. They're clearly tightening, and the deficit that they're projected for next year is going to be lower by 5%. So, and the domestic liquidity situation is reasonably strong. So in terms of the demand and supply for bonds, it seems like a favorable outcome. The second is that the Korean won has been bashed up quite a bit already. Whereas, the external developments are such that you could continue to see Korean won volatility. But the downside, at least on a fundamental basis, is somewhat limited from here on.
Sanjay, have a very good New Year and all the best wishes for 2012. Sanjay Mathur.